Global equity markets have been hovering near all-time highs for weeks. Normally, this momentum is a clear signal the underlying economy is thriving, but underneath the surface, the engine is knocking. Central banks are still holding policy rates elevated, and inflation in several major economies remains stubbornly above target. This diagram shows the anomaly. A steeply rising line tracks stock prices, while the flat bar graph below represents corporate profits. Notice the widening gap. Investors pay higher multiples for stagnant earnings. When shocks hit, downward spikes instantly snap back up. This creates a tension we can't ignore. Are markets rising because macroeconomic risks are actually fading, or has investor behavior mutated in a way that simply masks the danger for now? To understand the rally, look at who is holding cash. Institutional cash allocations are lower than their historical averages. Large investors have already deployed their capital. They are fully invested. That leaves the current momentum heavily dependent on retail participation. It forms a mechanical feedback loop. New money flows in, pushing prices up. Those rising prices act as a magnet for even more individual investors, sustaining the rally without requiring any actual improvement in business operations. But out in the real economy, businesses are running into a wall of friction. The cost of borrowing capital is rising. This diagram breaks down the math of that friction. Take a company refinancing a standard 100 crore block of debt. As the interest rate dial shifts from 5% to 7%, the company is suddenly burdened with an extra 2 crore rupees in annual interest. That extra expense drops straight into the net profit bucket, visibly shrinking the volume of earnings they actually get to keep, unless they can somehow grow their revenue enough to offset the loss. We are left with two conflicting realities. The stock market is pricing in near-perfect conditions, while the operating environment for businesses is tightening. The fragility in the system comes from that exact gap. The stock market is running entirely on participation and liquidity, while the real economy remains firmly tethered to the actual cost of money. This divergence trickles directly down to individual households. As the market climbs, people look at their brokerage accounts and see much stronger balance sheets. This visual demonstrates what economists call the wealth effect. As a household's portfolio expands, say from 10 lakh rupees to 12 lakh rupees, the dial for their consumer spending ticks upward. They feel more financially secure, so they spend more. Multiply that behavior by thousands of households, and tiny streams of new spending pool into a giant reservoir of corporate demand, injecting real money into the economy and temporarily propping up these company revenues. But there is a trap hidden in this perceived wealth. While asset values look great on paper, actual household cash flow is severely constrained. With interest rates still elevated, monthly EMIs for home and auto loans remain expensive. Add to that the pressure of commodity spikes. Intermittent jumps in oil, pushing it toward $90 a barrel, drive up logistics costs. That forces the prices of everyday goods higher and keeps inflation stubbornly entrenched. This triggers a chain reaction. Central banks see that sticky inflation and refuse to cut rates. Those high rates continue to squeeze corporate margins and keep household borrowing costs painful. The entire system is locked in a loop. A rising illusion of paper wealth is in a constant tug-of-war against the very real gravity of inflation and borrowing costs. Because the market has rewarded every recent dip with a swift recovery, investor psychology has shifted. The traditional margin of safety has been abandoned, much like a tightrope walker confidently crossing a high wire while the safety net below quietly dissolves. This creates a serious capacity problem. Since large institutions have so little cash sitting on the sidelines, there is hardly any dry powder left to deploy. If retail inflows suddenly slow down, the stabilizing force that buys the dips disappears. The survival of this equilibrium depends entirely on whether that incoming liquidity can continue to outpace the mounting cost pressures. From here, there are two realistic paths. This diagram illustrates the first option, the stretch. If retail participation stays elevated and the macroeconomic data doesn't worsen, the thick pillar of liquidity can continue holding up this highly elevated, trembling market line. The highs are sustained purely by investor behavior, not fundamentals. The second path is the snap. If constraints tighten, if oil stays high or inflation proves unshakable, that liquidity pillar cracks. The market line drops violently, forced to lock back into a lower baseline dictated by actual economic reality. A rising stock market doesn't mean risk has vanished. In this environment, it simply means the risk has been moved off the balance sheets and hidden squarely inside the fragile expectations of the investors buying the top.